Welcome to this explainer. Okay, if you're actively following the stock market, you are looking at price tags every single day. We all do it. But honestly, even seasoned investors can fall into the trap of letting a raw share price dictate how they perceive a company's value. So today, we're going to strip away all that noise. We're going to look at the foundational math that actually drives market valuation. We're moving way beyond the surface level tickers to understand the real mechanics of equity pricing, just to make sure that the next time you analyze a position, you're focusing on the metrics that actually matter.
Let's start by challenging a really persistent cognitive bias. Ask yourself, are you looking at the wrong numbers? It is incredibly easy to glance at a stock trading at, say, $5 a share and instinctively feel like it's a huge bargain. Or on the flip side, you see a $500 ticker and you flinch at the premium. We are just hardwired to associate absolute dollar amounts with how expensive something is. But applying that everyday consumer logic to corporate equities, it's mathematically flawed.
Section 1. The stock price myth.
Here's the reality. A low price tag absolutely does not equal a cheap stock. When institutional investors evaluate an asset, that absolute share price is practically irrelevant. The dollar amount alone tells you absolutely nothing about the underlying equity or even the size of the overall corporate pie. Looking only at the stock price without calculating the market cap or enterprise value is essentially meaningless. It's kind of like evaluating a piece of real estate based entirely on the price of its front door, without knowing the square footage of the actual house behind it. Without understanding the cash flow being generated inside, the nominal share price provides zero actionable intelligence.
Section 2. Decoding the PE ratio.
So instead of just looking at the price, the market uses a very specific tool. The price-to-earnings, or PE ratio, is the absolute baseline of valuation. It tells you exactly how much you're paying for every $1 of a company's earnings. Now, while we probably all know the formula, its true power is how it forces a mental shift. It pivots the fundamental question from how much does the stock cost to what is the premium on this company's profits. It completely reframes the whole conversation away from daily market fluctuations and grounds it in real, tangible business performance.
Let's baseline this with a standard multiple to make it perfectly clear. Say a company has a PE of 20. That means you are paying $20 out of pocket for every $1 of earnings that company generates over a year. If you flip that ratio upside down, it basically represents a 5% earnings yield on your investment. Thinking of it as a yield immediately contextualizes your capital, right? You're essentially asking, if this company paid out 100% of its profits to shareholders, what would my return be?
Now contrast that with a PE of 10. You're capturing the exact same $1 slice of profit, but the market is pricing your entry ticket at half the cost. You're getting double the earnings power for your capital, which represents a 10% earnings yield. You'll typically find these compressed multiples in mature, cyclical, or legacy industries where cash flows are steady, but the runway for massive exponential expansion has considerably shortened.
So the crucial takeaway here isn't just about screening for the cheapest multiple you can find. The PE ratio acts as a highly sensitive proxy for market sentiment. Basically, a higher multiple signals that a stock is more expensive based purely on current trailing earnings. But it also reveals that the broader market expects those profits to grow significantly in the future. You're paying a premium today for the anticipated growth of tomorrow.
Section 3. Real-world stock examples. Let's put this concept to the ultimate test and apply it to some massive tech titans you already know well. When we map this across Microsoft, Apple, and Tesla, the sheer divergence in multiples is striking. These are all mega-cap market leaders dominating their respective sectors, yet the market is treating their earnings in wildly different ways. It's a perfect showcase of how sentiment, sector dominance, and growth forecasts dictate valuation way more than raw revenue.
Take Apple, for example. Sitting at a PE of around 33, investors are willingly paying about $33 for every $1 earned. Now, in a vacuum, a strict value investor might totally flinch at that number. But this multiple reflects a massive, undeniable brand premium. Investors are actively choosing to pay up for an impenetrable ecosystem, incredibly consistent cash flow generation, and the downside protection of those massive share buyback programs. Then you compare that to Microsoft, historically hovering somewhere between a PE of 25 and 30. Despite an aggressive and highly successful pivot to cloud computing and AI infrastructure, investors are paying slightly less per dollar of earnings compared to Apple. This just highlights how differently the market weighs enterprise software growth and B2B dominance versus consumer hardware cycles at any given moment.
And then there's Tesla. Their PE has been known to jump over 300.
I mean, a $300 premium for just $1 of current earnings sounds mathematically absurd, until you realize you aren't really buying today's earnings at all. A multiple that high indicates the market is pricing in aggressive, exponential future growth. It's valuing the company way more like an unconstrained tech startup disrupting global energy and autonomous transport, rather than a traditional legacy automaker.
Section 4. The Smart Investor Mindset. This brings us to a crucial nuance, and it's where beginners often get tripped up. A low PE is not an automatic buy signal. In institutional finance, we call that a value trap. Often a multiple is sitting in the basement because the underlying business model is fundamentally broken, or sector headwinds are destroying future profitability. And conversely, a sky-high PE is not an automatic sell. It just represents incredibly high execution expectations. The ratio isn't some mechanical trigger, it's a diagnostic tool.
Always keep this core philosophy in mind. The PE ratio is just a way to understand how the market is valuing a company's earnings. It's not a magic 8-ball that dictates future price action. It is simply a lens. It requires you to look straight through the multiple and ask yourself, do I actually agree with the market's expectations here? Do I believe the growth will outpace this premium, or is the market being way too optimistic? Ultimately, remember that you are buying a future stream of cash flows, not just a ticker symbol.
So, the next time you pull up your portfolio app, do yourself a favor and ignore the basic price tag. Ask yourself what true value lies beneath it. Look directly at the earnings engine under the hood. Are you paying bargain basement prices for a dying business, or are you paying a massive premium for growth that might literally never materialize? The price simply tells you what you pay, but only the earnings tell you what you are actually getting. The real question is, do you agree with the premium the market has set?